All right. This is the recorded lecture for Chapter 3. We're going to go through Learning Objectives 3.1 and 3.2. 3.3 and 3.6 we'll handle those in class on Monday and Wednesday. Might spill over into Friday, but plan on Friday we're going to start Chapter 17. So let's get into this. All right, so 3.1 talks about a lot of the concepts of the income statement. Now, most of you know that the income statement shows revenues minus expenses, and that gets us net income. Okay, we're going to expand this to include other things too, like gains and losses. Okay, but also we're going to talk about the difference between net income and pre-tax net income. So net income is revenues, all the revenues and gains minus all the expenses and losses, gets us what we usually call pre-tax income. And then we're going to talk about how do we determine what is the tax and what do we do about the tax expense to determine net income and some other concerns as well. But realize that the income statement, when it comes to revenues and expenses, there are different types of revenues and expenses. Generally speaking, we think of revenues and expenses as those that occur from operations, actual deliberate actions from management. But there are also some other revenues and expense items that are not that important. And we'll talk about how we sort of divvy up even revenues and expenses into what are considered operating revenues expenses from non-operating revenues expenses. So that's sort of the preview of what this chapter is about. But let's talk in general about the income statement. What do we know about the income statement? And the income statement evaluates past performance of the company. Now, that sort of sounds like, well, were you looking in the past? What good is that? Generally speaking, looking in the past is fine. It helps us determine, number one, what actually happened, because the numbers we provide to our investors are audited. But it also helps us give us an idea as to whether or not what happened in the past met our predictions. So remember that relevant information is information that provides predictive value and confirmatory value. The net income that we show gives us a lot of the detailed breakdowns of what happened during the year. It gives us information about what happened in the past in terms of performance and then what will likely happen in the future. There may be some new items that we show that happened in just over the past fiscal year, but whether or not those things will happen going forward, we may need to actually provide more contextual disclosure in the footnotes after the face in the financial statements. Yes, we do provide some sort of indication of the uncertainty of future cash flows, but primarily we're giving information about what were the revenues that were earned regardless of whether or not we got the cash, and whether or not, and also what were the expenses regardless of whether or not we paid those expenses in cash. We try to smooth out revenues and expenses using accrual accounting, because that helps the investors get an idea about the prediction of the future. And investors love prediction. They love information. They love transparency because it reduces their uncertainty. A very uncertain type of a company will have a very low stock price. So we want to make sure investors are comfortable about what they're investing in. That's why we give them an income statement to help them alleviate any uncertainty, or whatever uncertainty exists that's inherent in the business helps them better assess the risk associated with those. The income statement doesn't tell us everything. We do have to leave out or omit certain items, and we're going to talk about those things in detail later. But realize that we cannot, in all practicality, disclose everything in our financial statement. So there's always something that gets omitted or has to be left behind. Income numbers are affected by the differing accounting methods employed. Yeah, that's a limitation as well. Perhaps we use different depreciation methodologies. Okay? Or maybe we, in our estimates of the useful life of a long-term asset, maybe we initially thought it was 10 years, but after a while we have to change it to maybe be shorter than 10 years or longer than 10 years. But companies can choose, companies have a lot of discretion over certain accounting choices. But that's going to obviously affect, if the depreciation method is discretionary, that affects the expense that's reported, and therefore whether or not that expense is consistent across the years and across different competing companies. Income measurement involves judgment. Of course, there's judgment. For instance, depreciation is a judgment, but also bad debt expense. Remember that we have to estimate the collectability of our accounts receivable. Sometimes we're just making a pure guess, and maybe it has a lot of different factors involved, or maybe there's not a whole lot of factors involved. But judgment is always present when we're looking at any type of revenue or expense recognition. So let's talk about revenue. Now, we know that revenue is usually what we show at the top of the income statement. So if this is our income statement right here, usually we show, hey, here's all the stuff, here's all of our activity that brought in cash or claims to cash. Remember that revenue can be just simply sales earned on account. So maybe we have cash that we earned from the sales revenue. There's the credit. Or maybe we earned sales revenue, but we haven't collected the cash yet, so we would debit that. The revenue item represents anything that we have actually earned by performing services or delivering goods. Generally, the revenue that you see up at the top represents revenue from central operations. You could have, for instance, let's just say there's an account called rent revenue. Rent revenue. Now, that may not be part of our sales revenue or service revenue, but why would we potentially have rent revenue? Imagine, for instance, that we're a delivery company. We have a warehouse, okay? And we usually store packages in this warehouse. I know this is kind of a bad drawing here. This is a delivery truck. Okay, we fill that in there. So normally our business is to deliver packages, and so that results in the delivery of goods results in service revenue. So say that's service revenue from delivering packages. But let's say maybe 2 or 3 months out of the year this warehouse is empty. Should we just leave it alone, or is that potentially an opportunity for us to generate other types of revenue? If we have an empty warehouse, say for 3 months of the year, let's go ahead and lease it to some other business. We offer an empty warehouse space for lease for 3 months of the year. We charge people rent revenue. As we earn that, we'll record rent revenue. That won't necessarily be shown up at the top of the income statement. It may be somewhere in the middle, rent revenue, where we just want to distinguish, hey, we did earn revenue, but it's not part of our core operations. Nevertheless, we want to show this to our investors. If anything, we want it to pop out separate from our core operations because we want to show our investors that we have a resource that we do not let go to waste. So when we're talking about revenues, generally we're talking about those that result from central operations, such as service revenue. But if we do have any type of incidental revenue, say from subscription fees, or maybe we're a bank and we have, excuse me, not bank, but maybe we have dividends from investments. Those usually, those types of revenue items are incidental to investing in other corporations' common stock. Microsoft, for instance, can own Apple stock, or it can own Dell stock, or it can own Ford stock. Okay, companies that have investment accounts, they take some of their idle cash, they buy stocks and bonds, just like you and I do. If there are dividends from those stocks, those will be recorded as dividend revenue, and they'll be placed somewhere towards the bottom. But the key thing to realize is whether or not these revenue accounts appear up at the top or somewhere towards the middle of the income statement depend on the core operations of the business. Interest revenue is something we would expect from a bank, and that type of company would show interest revenue at the top. Their job is to charge interest to customers. If there is an interest revenue and the company is a bank, put that revenue, that interest revenue, towards the top. If, however, it's not a bank, let's just say that we have a note receivable outstanding, maybe we're just a motorcycle manufacturer. If there is interest revenue and it's incidental to the business, we'll put that somewhere in the middle of the income statement, just to make sure it's separate. So revenues are more complicated than we think. Generally, revenues are core operations. They appear at the top of the income statement, but there are other types of revenues that we can earn along the way. Expenses, just like there are different types of revenues, there's different types of expenses. We want to make sure that all the expenses that are associated with the central operations are put closely next to the revenue that we see at the top of the income statement. And we want to have the core operations up here. There may be other types of incidental expenses that we want to put maybe down at the bottom. One thing for certain, whether or not a company has expenses that are core versus incidental to the business, they will always have a tax expense, and tax expense is usually towards the bottom. So are all the expenses on the income statement? Yes, they should be. Where are they primarily located? Usually with the core operations. Incidental, maybe they might have some other types of expenses that are incidental to the business. Maybe they do, maybe they don't, but they will have a tax. It's at the bottom. We talked about gains and losses before, so we need to make sure that gains and losses become part of our lexicon when we're dealing with transaction analysis. Yes, there are gains. Gains happen that are incidental to the business. There can also be incidental revenues, but generally when we use the title gains, some type of gain from a sale, we're saying that, hey, it's incidental to the business. It's not part of our core transaction. Maybe we have a loss from selling some of our equipment. Again, that's incidental to the business. We want to make sure that these items are separate from the core operations of the business. So yes, our income statement is going to have essentially two main categories: core ops over the top and other stuff towards the middle or the bottom. And generally I would say if you have gains or losses, they're going to see that towards the other stuff. We want to make sure that investors know, yes, if there were economic inflows or outflows, whether or not those particular items are part of the core operations of the business. What you're used to seeing when you think of an income statement, what you're probably used to seeing in your mind is revenues at the top, expenses at the bottom, and then some sort of form of income at the bottom, net income. Now, when we say net income, I want you to realize net income means post-tax or after tax. Net income is a specific item. It means the bottom line. Okay, and usually what we do is we take that amount and we convert it into what's called an earnings per share number, depending on the weighted average shares outstanding. But this type of income statement is not very useful. We cannot determine from looking at above here, say for instance net sales, you have dividend revenues and you have gains. Are these part of the core operations of the business? You don't really know because you're mixing them all together. What about down here? Yes, I can see, well, I've got income tax, okay, but what about this loss from the flood? Is that something that I should expect normally with like cost of goods sold or any type of selling expenses, right? Is it part of the core operation or not? We can't really see. So the single step income statement is not very useful. That's why I put a frowny face there. Companies, corporations produce a multiple step income statement. And as far as if you're a financial analyst, you are grateful for this because you don't want to make any guessing games about play any guessing games about the numbers you see on the financial statement. So fortunately, we're able to see a corporation's core operations towards the top and its non-operations or other stuff towards the middle or the bottom. But notice in particular the titles that they use here, core titles. Yes, you have account titles like sales revenue, but you might have an account title called dividend revenue. You want to make sure that if dividends are not part of your core operations, they're put down in this other category. Notice the word other appears. Other gains, other losses, other revenues, other expenses. The key word there is other. It means it's not part of the core operations. It's incidental to the business. Okay, it happened. Yes, it affects overall net income, but we want to make sure that what management is actually doing on a day-to-day basis is up towards the top. This is management's decisions up here. Okay. We're going to go through these in details, but realize these are the core distinctions here. You want to be able to look at the income statement in kind of like two different pieces here. Also notice at the bottom here, yes, revenues minus expenses equals quote unquote net income, but we're going to look at different titles. We're going to look at income before income tax, that's pre-tax. Net income minus the income tax gets us income or net income for the year. Net income is the true bottom line. This is post-tax or after tax. Okay, we have to worry about taxes right now, okay, because taxes matter. More to the point, cool thing you can see here about having income tax at the bottom, you can look at this and say, what is this amount as a percentage of pre-tax income? You can determine what their tax rate is just by looking at a multiple step income statement. So up at the top, when we look at revenues, what do we see? Well, we see the core operations of the business, sales revenues, and we also have to put up the top here any type of sales discount, sales returns and allowances. We'll talk about that later. But we want to make sure that if these are the core revenues, we want to match the expenses that were incurred that helped us generate those sales. Remember that expenses, we want to use the matching principle. The matching principle is also known as the expense recognition principle. But the idea here is to say, if we earn sales, what were the specific expenses incurred to get those sales? Put those close together to help us determine the core number, income from operations. One way that sort of helps us quickly see what are the differences between the core operations versus the non-core operations of the business are these intermediate titles here. We get gross profit, income from operations, and then income before tax. Sometimes these are indented pretty clearly, sometimes they're not. But the key thing here is when you're looking at subtotals, you need to be able to spot whenever something is being summarized here. So a gross profit says, hey, take the net of all your sales and subtract off your cost of goods sold. Get us a gross profit. That's a first. Generally speaking, it's the first net subtotal you see towards the top. Then you have all your SG&A down here at the bottom, and then you have your other stuff. Okay. Having these subtitles allows analysts to quickly run some quick performance analytics. If you're looking at expenses, though, be careful. Generally, we know that cost of goods sold is a particular account. Okay. Complicated businesses may have multiple cost of goods sold accounts based on the number of products they have. But so far, we're pretty familiar with one T account called cost of goods sold. But we don't see a T account called selling expenses or general administrative expenses. I don't want you to confuse these with actual account titles. These are actually just summaries. And they're summaries of various types of expense accounts. So what are the different types of selling expense accounts? Well, maybe in the footnotes to the financial statements, you will see the detailed breakdown of all the individual T accounts for these types of selling expenses and then another type of administrative expenses. You might see that. Maybe you do, maybe you don't. But when you see the title, selling expenses, what they're doing is they're taking a bunch of different T accounts and they're just trying to summarize it. Is that kind of opaque? I mean, we want to have very transparent financial statements. Shouldn't we, for instance, maybe have this particular account stick out on the income statement and then leave the rest as just other selling expenses? Maybe. Companies have a lot of discretion in terms of how many accounts they summarize, whether they summarize all of them, call them all selling expenses. It's their choice, okay? Bottom line is there is a separate section after the face of the financial statements called the notes or the footnotes that can give us more explanation as to what these things are. But when you look at the totals, a summary, 453,000, you will probably need to do some digging to find out what primarily this expense summary is comprised of. Going back to net sales for a second here. Yes, they summarize expenses, but they try not to summarize revenues because revenues are closely looked at by investors. So yes, there's a sales revenue account. Okay. Now, these are regular types of sales. Sales revenues generally occur from selling pizzas or motorcycles. Sales revenues means selling goods. If it's services we provide, usually we call that service revenue. So sales revenue means we're probably selling inventory and we'll have a cost of goods sold. Sales revenue, the T account, that's where we put all the credits. But what if we offer, say, some type of discount for early payment of sales on account? Generally, these are debit balances. They're not expenses, but they do offset any type of revenue. We also may have people who return goods that are defective. So any type of returns, those will also be debits. We'll keep track of those. But again, they're debits, they're not expenses. Consider these like contra revenue accounts. Okay, these debits will offset all of our sales, gross, not icky, but just gross total. Gross sales were $3 million, but we offered some discounts for early payments, and we also had some returns. So the total amount of $80,000 is subtracted from the gross sales. Net sales represents here's truly what we brought in from selling goods. Take the net sales, okay? Subtract off the cost of the inventory. Yes, we sold shoes. If our shoes retail price is, say, $100, but the cost from the inventory account on a per unit basis is, say, $20, then 80 represents on a per unit basis the gross profit. Okay? Is that something that investors want to know? Absolutely. So we try to look at any specific sales revenues minus their specific cost of goods sold to determine a gross profit, because a lot of times we want to compare this number or compare that number on a scaled basis to other competitors. So we want to look at Nike's gross profit scaled versus Under Armour's gross profit or Adidas gross profit. Okay? So a gross profit subtotal, a net subtotal, usually towards the top, that's pretty common for any type of manufacturing organization or an organization that sells any types of goods. But that's not all the expenses, of course, right? We know that there's salaries and wages. We know we pay commissions. We have to pay for utilities. There's depreciation. There's all of those things that go on behind the scenes, right? So yes, here's the revenue. Here's the costs on a per unit basis. But here are all the other things going on behind the scenes. We try not to take up too much space on the income statement with that information. That's why we want to summarize. Summarize this as much as possible. Pop out maybe a few accounts that are pretty significant, but let's be clear. SG&A, that's all the necessary behind the scenes type of expenses. Investors don't really judge companies based on their utilities expense or even necessarily their depreciation expense. Those things happen, but they do definitely want to see specifically what are the account titles for cost of goods sold and sales revenue. Once we take the gross profit, subtract off all the behind the scenes expenses, we get this number called income from operations. This is a pretty key title. It's not quite EBITDA, but it definitely represents the performance of the company. Here's what the company's in the business of doing: selling goods and generating a profit from doing so. These are the core operations. So this is the core profit of just running the business. We're not done explaining what happened during the year, but we want to show the core profits from just doing what we do best: selling pizzas, selling motorcycles, selling tennis shoes. Okay? Income from operations does not include any tax. Okay? We'll deal with tax later, but this sort of raw number here is something we can compare against other competitors to see, hey, how profitable are other companies at just selling their shoes or selling their motorcycles? This is a number that's often compared against other competitors, but it's definitely something we want to show in an income statement year over year. Oftentimes we'll have, if this is the current year operations, we'll have prior year numbers right next to it, so we can see how the company did year over year. But what about the other stuff? There's incidental things that go on. We call those things unusual and or infrequent type of activities. Unusual means you don't expect to see it. Its occurrence is very abnormal. Maybe we're not used to having a hurricane come through and destroy a warehouse. So it's very unusual. But if we're in Florida, for instance, and hurricane damage happens to companies in Florida. It's if it's something that does happen, it's not completely weird or out there. We wouldn't necessarily say a loss from a hurricane to a business in Florida is unusual. We may just say it's infrequent. Yes, we have operations in Florida. Yes, occasionally hurricanes come through, but they're not very frequent. We can't predict these things. So whether or not some sort of loss or even a gain in the course of business is something that is really weird, or just something that says, yeah, it happens every now and then. We generally call those other things, we put those items towards the bottom because they're either unusual or they're infrequent. Certain types of unusual or infrequent gains or losses that we might see in a business are write-downs of our receivables or inventories or property, plant, and equipment. Hey, we sort of realize that we're not going to generate as much, we're not going to produce as much product from this particular machine. And in fact, we may have to scrap it. Or maybe, for instance, EPA came in, Environmental Protection Agency comes in and says, you can no longer use this machine. It's causing too much environmental damage. Great. So we may have to take a piece of equipment and completely scrap it, write down the rest of the net book value to zero. There are restructuring charges that occur if a company is going to say, take a big bath. And a lot of companies did this during the pandemic. They had a lot of assets that weren't generating a lot of profit. So they said, let's just sell it all off or write down the book value to zero. Maybe we have to abandon certain operations. Hey, we're trying to drill for oil in a particular area. It's not happening. So any type of investments we have in other parts of the country, maybe we just go ahead and write those off to zero. Yes, there are losses due to strikes. Maybe if we pay off our debt early, we have some sort of prepayment fees. Sale of investment securities. Generally, if we're not an investment bank, we're say like Harley Davidson, right? If we have idle cash that's invested, maybe we sell that at a gain or a loss. That may happen, okay? But we want to make sure it's clear that these are gains, these are losses, and of course, they're either unusual or infrequent. So when we show these things, do we want to show a lot of detail? Remember that a lot of the core operations have already been explained up at the top portion. So when you get down here, you want to make sure that you're being forthcoming, you're being truthful, you're being transparent, but you don't want to draw too much attention of these incidental items because it may take away from the more important stuff up at the top. That's why we put the core operations at the top, the less important stuff towards the bottom. It is important, just not as important as the core operations. So what do you notice at the bottom here? Other revenues and gains, other expenses and losses. It's kind of telling you, hey, we had some other stuff that happened, but don't freak out about it. We're just making sure we're pretty clear about how this stuff overall impacted our income from operations and overall net income. Maybe these things are good. I mean, you can look at this right now, this is this example, and say, yeah, we brought in $186,000 from selling pizzas. But this incidental stuff, maybe it was good, maybe it wasn't that good. Notice how we had some other gains and other losses towards the bottom. What's the effect of these things? We'll take a look. 186 from our core operations, but this incidental other stuff that happened actually brought up our income before tax to 231. So should we be excited about this number, or should we be more excited about this number? Some people look and say, hey, a higher number is a better number. But the key thing you want to look at here is this is stuff that's going to be recurring. Okay? The effects of these items here are unusual or infrequent. We cannot depend, say, for instance, on next year producing $171,000 in gain. And we shouldn't freak out if we have an unexpected loss of $126,000 this year. May not see that next year. So that's why we want to make sure up at the top, hey folks, this is our core operations. This stuff down below, yes, it brought up our overall income pre-tax, but let's not get excited about that, okay? All right, so core operations, 100. Let me back this up here. 1 second. Okay. Check. All right, perfect. Core operations of the business, 186. This is what happened during the period. Yes, we had other stuff that happened. This 171, yay! But it's infrequent and or unusual, so let's not get excited. We also had this weird looking $126,000 net loss or other expenses, other losses down here. So let's not freak out. That is not good to have happen, but it's other stuff. So make sure that investors can see what the core operations are and make sure that they know, hey, how they got to this 231, whether it's higher or lower than core operations. Income before income tax. Is that a number that people really spend a lot of time fretting over? Not necessarily, but I'll show you why it is useful. When you look at the income tax, what's oftentimes called the income tax provision, provisions usually say, hey, these are approximations or estimates. We're estimating what our tax liability is going to be. In general, so are you when you file your tax return. Here's what I think I should pay the IRS, or here's how much I think the IRS owes me back from all my withholdings. They're an estimation. Ultimately, the IRS will decide whether or not you're correct. So when we make a provision, we're simply saying this is an estimated amount of tax that we have to pay on what? Our income before tax. So by showing income before income tax and then showing income tax right after that, what you can do is determine, hey, what is the tax rate? Take the 66, or we'll call it roughly about 67,000 in tax, and divide that by the 231, roughly about 231, to determine the effective tax rate. That can be useful to compare against other companies, but realize other companies like Nike, for instance, they don't really have a comparable tax rate or tax rate that's comparable to, say, Under Armour, or even a smaller business that doesn't have as much of a global outreach. Tax rates are based on several things, and it's well beyond the scope of this class. But, for instance, there may be certain tax credits that reduce our tax liability. Some companies may have them, other companies may not. But whether or not certain companies have certain tax advantages, that's going to affect their specific tax rate. So tax rates, yeah, it's kind of interesting to know what they are. You can determine that by looking at the income statement, a multiple step income statement. But I wouldn't fret if I saw a really high tax rate. Corporate taxes between 30 and 40%, that's not too unusual. Corporate tax rates that are, say, 0, that makes me nervous. So we have income before tax, then we have our tax expense, what's left over. Finally, net income. This is also known as earnings. Net income, earnings, same thing. Sometimes I call this positive earnings. Profit, positive earnings, loss, negative earnings, right? That's why we tend to call this either net income if it's positive or net loss if, unfortunately, expenses are greater than our revenues. But net income for the year is 164. Is that informative? Of course it is. It's more than 0, and that makes us happy. But what use is that to us? We want to show investors what that particularly means to them. And if you're an investor, if you're a stockholder, you have a claim to some of this 164. But what is your claim? Well, it depends on the number of shares that are outstanding. So earnings per share, or EPS, basic EPS, we're not going to worry about dilution. Earnings dilution is something you talk about later on in intermediate 2. But if I'm a shareholder and I am, say, either the sole shareholder of the business, I own all 100,000 shares of the business, I want to know what that 164 amounts to on a per share basis. Well, I'll take the income after tax. There it is. And if I don't have any preferred dividends, I can just leave that 0 and then just divide it by the weighted average common shares outstanding. What this 164 means, and I'll talk about these other items in a second, but what this 164 means is if there's anybody out there, any stockholder who has 1 share per share, if you own 1 share of this particular company, you have a claim to $1.64 of this net income. You have a claim to it. You do not have a right to it. A company needs to actually declare a dividend for you to get any of this in cash. But if you're a shareholder, if you own one share and the company reports $1.64 per share, that might mean something to you if you also own, say, one share of another company. Companies will disclose not just their net income, but their net income on a per share basis so investors can figure out, hey, am I really getting the most from my investment in this company? Maybe $1.64 per share isn't that good. Maybe I can take my investment, put it into another competitor type company, and maybe get, say, a claim of $2 per share or $2.50 per share. That might sound more attractive, but that's really one factor you would want to consider in addition to several others when you're making an investment decision. Nevertheless, this is just gives investors the idea, puts the amount of net income into context. Remember what we're doing here is we're scaling. We're scaling raw numbers that we see in the financial statements to make them more meaningful for analysts and investors. Because a number that's greater than zero, hey, that's a profit. But what does that really mean? That's why you want to scale numbers. That's why you perform ratio analysis. Before I get too far into this, a couple things you need to be aware of, especially for the exam. Number one, preferred dividends. If a company has preferred shares are issued to preferred shareholders. If you're a preferred shareholder, you get paid dividends first if a company pays any dividends. The common shareholders, they go last. They get the scraps afterwards. So if there are any preferred shareholders, usually the amount of their dividends is going to be pretty well specified in their particular preferred share contract. But the company still has to declare dividends for that to actually mean anything. What about this WAC, shares outstanding? What is that all about? Weighted average shares outstanding represents roughly the average number of shares that have existed since the beginning of the year. So when you look at a company that, say, at the beginning of the year, January 1st, had 100,000 shares outstanding, okay, that means it printed and gave to outside investors 100,000 pieces of paper. But what if somewhere in the middle of the year, say in April, starting in April 1st, let's just say the company printed another 100,000 shares and put it all out there to investors. Maybe the existing shareholders got that extra 100,000 shares. Maybe this 100,000 went to new shareholders. Who knows? The key thing about this is when you're looking at the number of shares outstanding during the year, you don't want to just simply say, well, here's what we started with, here's what we ended with, and just divide that by 2 to come up with an average. A weighted average calculation in general says if you can identify at specific points in time an observation, that particular observation represents a data point. So throughout the year, if we say we had 100,000 shares at these points in time, at every month during the year, we can say that's an observation. Let's add up all those observation amounts and divide it by the number of actual observations. This is the key calculation of any type of weighted average. When we do that, we say, okay, the first part of the year, there's 300,000, then you had 1.8. So overall, you add that up and say 22.1 million shares during the year. No, these are just weighted averages. When you sum up all the amounts of the data that you observe, take that and then divide it by the number of observations. What you see is the weighted average of shares during the year was 175,000. It wasn't 100, and it wasn't 200. We started with 100, we ended with 200. But if you just simply said, well, what's 100 plus 200? And you just divide that by 2, you get 150. So on average, there's 150,000 shares outstanding. No, that is a simple average. And you got to get used to, whether you're an accounting major or finance major, you got to get used to running weighted average calculations. So weighted average says, look, we had most of the for the first half of the year 100,000, but most of the year it was heavily weighted towards the 200,000. So if you think you got 100 over here and you got 200 over here, think about like a kind of a seesaw, right? Which one is sort of more heavy? Obviously the 200 because it occurred more often. So when you look at the weighted average, you can say, okay, the once is roughly about 175,000 shares was outstanding during the year. It's a rough way of helping us determine what is the average, the earnings per share on a weighted average basis. Determine that the weighted average is shares were 175, then rerun your calculations. What do you see? Well, the earnings per share goes down. If the denominator decreases, then the overall calculation, or excuse me, if the denominator increases, then the overall calculation, the ratio is going to decrease and vice versa. You want to practice this, but you want to spend time thinking about why weighted average matters more than a simple average. Take a look at this scenario too. What if you started with 100,000 shares, and let's just say most of the year there's 100,000 shares outstanding, but in the last month we issued another 100,000 shares. Total shares outstanding for December was 200,000, but most of the year there's 100,000 shares outstanding. What's the average? What's the average number of shares that were outstanding throughout the year? Again, don't take 100 plus 200 and divide it by 2. That's a simple average. Weighted average says, look, you have 12 observation points. What is the observation here? What's the observation here? So on and so forth. Add up that whole amount, divide it by 12, or multiply it by, if you will, 1/12. That last little bit, 11/12, the other part of the year. Doesn't really matter. Add up all these things. What do you see? 100 times 11. 100, oh, come on, baby. Excuse me. Back this up. 100 times 11 gets me 1100, right? Then 200 happened 1/12 of the year, so just leave it as 1/12. Let's leave it times 1. 1,300, and then divide that by 12 observations. What do we get? Weighted average 108,333. So what we're seeing up here, I'm showing it to you in different ways, just another way of looking at it. How often do we see 100,000 throughout the year? 11 of the 12 months. How often do we see 200,000 total was throughout the year? Only 1 of the 12 months. Add them up, 108,333. What does this mean? Take a step back and say, well, those are all just nifty calculations. This was the number of these were the number of shares outstanding for the period. Okay, it wasn't 100, it wasn't 200, it's somewhere in the middle, but not straight up 150. Most of the year it was pretty low. That's why 108 makes more sense. Yes, we issued more, but for most of the year was kind of hovering around 100,000. So that's what a weighted average does. It applies weight to certain observations, just like one person, one vote. 152 is our basic EPS. Why is that? Well, this is small. Okay, so because the denominator is small, therefore this becomes big. Small denominator, big result. This was a big denominator, small result. So what do you kind of see between the two of these things here? If there's a lot of shares floating around out there, your claim to the net income gets smaller. You get diluted. We're not going to talk about dilution effects or how that works, but just realize the fewer the shareholders out there, the more each share has a claim to the amount of net income. By the way, too, something to realize, why do corporations get a lot of flack for buying back their own stock? Well, when they buy back their own stock, they reduce the weighted average shares outstanding. Therefore, the remaining shareholders, they get a higher EPS. It seems kind of devious how corporations use share buybacks, but they do it for strategic reasons more than anything else. All right, another thing here, when you're looking at the problems, break it out. Company has net income of 350, pays preferred dividends 50, and a weighted average number of shares. I'm just giving it to you in this case is 100. What's the EPS? Plug it in, figure out what the calculation is. Boom. You have plenty of practice doing this on the homework, so make sure that you practice this stuff. Simply watching me show you this isn't enough. Separating operating versus non-operating, or core versus non-core activities, we see that B on a multiple-step income statement, not a single-step income statement. Remember, single-step income statement is not that useful to us anymore. 3.2, what do we see now? Okay, special circumstances. Okay, multiple-step income statement can be complex. That's why you want to practice in the homework sorting out certain information so you can see how it all transpires. But realize that even if a company has certain unusual or infrequent items, it may have certain infrequent or unusual items that require specific disclosure on the income statement. And generally those unusual or infrequent types of activities revolve around discontinued operations and other comprehensive income, OCI. Discontinued operations often happens, say, when a company does restructuring. And when they do that, they say, look, we're going to separate off a part of the business. We don't want that part of the business to be commingled with our ongoing operations for next year. So let's talk about discontinued operations. A lot of people get confused by that. Two things happen. The company eliminates operations from a component of the business, e.g. a subsidiary, or a division of a business. Number two, when they eliminate that component, it represents a strategic shift. It has a major effect on the business. So if a company says, say for instance a company, it has 3 divisions, 1, 2, and 3, okay? And let's say each one of these roughly contributes an equal amount to the profit of the business. So this division, it's doing well, has a contribution about 33%. This one contributes about 33% of the profit, and so does this one. Okay? But what if in one particular year we see this one's kind of lagging? Maybe it has a loss, a net loss. Well, it's dragging down the overall performance of the corporation. If that division does not hold its own weight or pick up the slack, it's going to get chopped off. So if we want to get rid of this thing, what do? Well, we want to show on the income statement the company as up at the top, core operations for divisions 1 and 2. Okay? And then we want to show the income from those core operations. But what if 3 is still operating for us? We want to put 3, the effects of their operations, at the bottom. Maybe in prior years what we saw was the core operations of the business 1 and 2 and 3, but it's different now because in this year we're going to get rid of division 3. We just want to show the top portion of the income statement just as 1 and 2. So we cannot compare current year with prior year because prior year shows core operations with the 3rd division. This year we want to show core operations that will continue going forward and put 3 down at the bottom. So the reporting now has to change. We cannot show last year's numbers this way. So if we have an income statement, if this is current year income numbers, and we want to show the income information from prior years, right next to it, we want to rewrite it and say, here's what prior year's division 1 and 2 showed as income, and show number 3 towards the bottom to make it comparable. And the reason why we do that is, again, to highlight the fact that 1 and 2 is what we're going to use going forward. This will eventually be eliminated, but maybe it's still contributing some income. Who knows? Key phrase you're going to see here is net of tax. Please, for the sake of midterm 3, don't forget that. All right, so going back to looking at this Paquito. Okay. Now, we show, imagine we have a multiple step income statement, okay? And we show income from continuing operations. Now, what this represents before was net income. And then before, what we used to do is take that net income and then we put it into earnings per share. Right? We're not going to do that if we have discontinued operations. Okay? So we're going to discard that. We're going to say, look, what our net income is going to be based on just the continuing operations. Put in the number, do our calculations, revenues minus cost of goods sold, we get gross profit, minus any selling general administration, etc., and then get down to after that particular tax from those continuing operations, get us that 276. That is what we want to show this year, and we want to let investors know that this is what they want to compare against next year's numbers and the year after that. But what about any other items that the business has another division and it has activity? What do we do with that? You push it down to the separate section. In other words, you break off the company into kind of two different components, the continuing side and the discontinued side. Continuing is up at the top, and then discontinued is towards the bottom here. Does the division, if this is division 3, we're trying to get rid of division 3, did it have any, is it still in operation? Even though we're going to discontinue it, maybe it's still functioning, maybe it's still generating revenues, it still has its own expenses. Is there any net income or net loss from this division in the current year? Well, we're going to put that net income item there, net of tax, right there. That $54,000 represents that division's after-tax net income. And what you can see here is it's actually positive. So you look at this and say, hey, that's good. You're getting rid of a division that actually shows after tax a profit. Why are you getting rid of it? Doesn't really matter. The company doesn't want to have that division anymore. Maybe it's a loss, maybe it's net income, but the bottom line here is we're not going to show a separate income statement for this. What we're going to do is just give its net income after tax its own line item, and we're also going to show, hey, was there any type of gains or losses from selling off piecemeal any of the equipment or any of the patents or anything of use from that division. Here they're showing a loss, but notice that it looks like a positive number. You've got to be very careful when you read these items here. This is income, so that's a positive number. This is a loss, so this is a negative number. We don't like using pluses and minuses on the income statement because it tends to muddy things up. But if we can use verbiage, it actually helps us a lot more keep the numbers clean. When you net these two numbers together, what do you see? $36,000 net loss from that particular division. It is showing signs of what looks like good health, but we're selling off piecemeal the assets. And so overall, that division is dragging down the business. We want our investors to know that these are our core operations. The division that still exists that we're going to get rid of is actually bringing down the overall corporation. So 240 is the net income for all divisions, including the discontinued ones. So when you look at this, you can say, hey, 240, that's the company overall, regardless of whether or not it's continued or discontinued operations, the company has net income of 240. That's good, right? I would agree with you. However, 276 is actually a better number. And that number represents what the investors should expect to compare to going forward. This is the continuing operations of the business. This is just some leftover stuff from a division we're getting rid of. 240 for the overall business. That's useful to know. And knowing that 276 is really what's coming from the core operations, the continuing portion of the business. What about this? It gets a little crazy. Okay? When you're looking at discontinued operations, realize that the numbers that you see in discontinued operations are generally after tax. So when you're looking at an example here, it says, hey, this company decides to discontinue its electronics division. Okay, so Multiplex Products, Inc. Okay, it's going to splice off the electronics division from the rest of its business. Okay. In doing so, we have to be careful. During the current year, the electronics division had lost they lost 375 from operations. This is before tax. So you look at this and say, oh my gosh, no wonder why you're getting rid of that division. It sucks at trying to make money. This is the number before tax. Okay. When the company then also sold the division at the end of the year, sold off all of its assets, it incurred a loss. And sometimes this makes more sense than doing a write-down. To sell off all the assets, is there any type of a loss or a gain from that? In this case, there's a loss of 625. Nobody wanted the assets from this particular division. There's a loss, and it's also before tax. Oh my gosh, I'm glad I'm getting rid of this electronics division. It's a dog. Okay. Getting rid of this division represents a strategic shift. Okay, fine. I can isolate it. It's its own division, and getting rid of it is a major shift. It's a major component. We're getting rid of it. For the current year, the company reports income before income taxes of $25 million. I'll show you how to break this out. It's going to be very clear in the problems. Assume a 20% tax rate. How would you report this? Okay. So I'm going to report these numbers in zeros just to make it a little bit easier. Okay. So what we see up at the top, okay, this is the company, all but the electronics division. Okay. We want to keep that up at the top because that is what investors are going to look at next year when they do year-over-year comparisons. Down below discontinued operations, here's just electronics division stuff. Okay. Loss, remember, loss implies that's a subtraction. Another loss implies that's a subtraction. Total net loss from the electronics division is 800. Okay. Income from continuing operations, the continuing portion of the business, is 20 million. Okay. That's a positive number because we say it's income. But we still have the effects of getting rid of a division, so net income from all divisions. The whole company had net income of 19,200. We showed investors, however, that yes, even though it's 19,200 for net income, really this is what they should be focusing on. This is just the effects of getting rid of one of our divisions. Okay. We show this to investors so they're able to make a clear a clear distinction between what they should expect to see going forward. They should expect to see these results going forward. These results, the effects of this division, will no longer be a problem going forward. So, Beasley Enterprises, here's another example, has income tax rate of 30% for the current year, has income before income tax of $250. Beasley also has discontinued operations, a $0 operating income loss, and a $100,000 gain before tax. Okay, how should they report this information? When you see, okay, any type of discontinued operations, what you have to say is show the continuing at the top, discontinued bottom. Okay, separate it out. Yes, this represents all of the company. Okay, but we want to make sure the top is the stuff that investors see first. So, income before income tax of this, income from continuing operations. What this represents is all continuing divisions. Okay, 175. There is a discontinued operation. This is just the discontinued division, 70. And notice it's a gain, so you want to add that. Okay, you got to read these things carefully. Income means there's a positive. Gain means that's a positive. So the net income of the company overall is 245. And you might think like, well, why did we get rid of this particular division? It doesn't matter. You just need to know what it means when a company shows discontinued operations below its continuing operations. This part of the business is continuing. This part they will not see going forward. But this is the total company overall. So we know that we're separating the business between that which is going to continue on going forward and that which, hey, had operations maybe, but shouldn't expect to see that going forward. What we're doing is taking the whole business, if you will, the whole company, okay, whole company's activities, looking at whether or not it had any net income or any type of net loss before taxes, showing the tax effect, right, and then showing the net income after tax. Okay. Generally speaking, companies will have profitable operations. Yes, it will pay some tax and it will have net income. But what if in a particular year we decide to dissolve one particular division? We want to basically break out these components between continuing and discontinued operations. We want to say, hey, look, it's not enough just to have it all commingled like we did before. What we want to do, especially for this year and for comparison purposes, show last year's in a similar way. We want to show continuing operations, whatever their net income before tax was, and the discontinued operations there. We want to show the tax for continuing operations, the tax for discontinued operations, and what is the net income for both separately. Maybe it's net income. On the discontinued side, usually it's net loss. But the idea is to sort of break the company into different sections. The intra-period tax allocation concept is basically saying when you display discontinued operations, make sure it's pretty obvious what is the pre-tax income, what is the tax expense or benefit associated with continuing and discontinued operations, and then overall what is the net income or loss after tax for both divisions. We'll still add these guys together and show what the total company is, but we want to make sure it's clear what the tax implications are of discontinuing operation. That's why we call it an intra-period tax allocation. We want to highlight the tax effects from continuing versus discontinued operations. Now, Paquito, when you look at the income statement up at the top, it's not very clear what the inter-period tax allocation is. So what I want to do is show you essentially how all the information up at the top breaks down into these components at the bottom. Now, what we do see from this information is the core continuing operations before tax, the continuing operations tax, and the continuing operations net income of 276. So when you look at this, I'm just going to summarize it over here. Continuing operations, you see they have pre-tax net income of 460. They have to pay tax 184, and what's left over from continuing operations is 276. Okay, but that's not the whole company. This is just the continuing portion of the company. The discontinued portion of the company is broken down between any sell-off of their assets, whether there's a gain or loss, and any operations income or loss. So the discontinued operations is just the discontinued division. Okay. What happened here? Now, notice that they're not giving us a complete income statement breakout for this division. That's okay. We really just want to see the summary. Did the company have an income or loss from operations? And then also, is there any gain or loss from selling off the division? Okay. What we see here isn't necessarily very clear, but that's okay. What I do see is income from operations less applicable income tax. In other words, these numbers are net of tax. Well, that's good because essentially this number right here, that's net of tax. So any information we show below net of tax, we want to keep it net of tax. We don't want to commingle any gross numbers from tax numbers. So what we're doing here is we're saying continuing operations net of tax 276. Was there any income from the pizza division net of tax? Yes, there was, 54. Okay. 54 is income net of tax from the discontinued operations. Okay. And what about the loss? It sold off some of the assets. Did it have a gain or loss? No, it had a loss. That means this is a minus. Got to be careful about that. 90,000 loss. I'm going to put that in a negative sign right there at the bottom. Okay. Now these are just net results. Okay. And generally speaking, what happened up here, we don't really care too much. I mean, we can kind of fill in the information from above, but really what we want to get to is figure out what is the overall corporation versus its corporation between continuing versus discontinued. When you add up all these numbers, the whole company, discontinued and continuing and discontinued operations, what you see is a 276 plus the 54 minus the 90 gets us 240. The company as a whole was profitable, even with the discontinued pizza division. The company had net income after tax of 240. And notice that's what they're showing right here. That's the net income of the whole company. Okay, continuing and discontinued operations, 240. And this is, of course, net of tax or after tax. Okay, what is up with all this other information here? Well, we're just trying to break down the discontinued operations without giving too much color to it. Okay, notice how they tell us, hey, these numbers are net of tax, but they tell us how much tax there was that affected those numbers. Now, a couple things you want to be careful with here. If there is net income, then there's going to be tax that we owe the government. If there's a loss, the tax, quote unquote, the tax effect is actually a tax benefit. Don't worry about that. 24800 represents how much tax just that division is responsible for paying the federal government. But if it sold something at a loss, we actually get a benefit, in this case of 41,000. That actually is good for us because it offsets any other types of tax liabilities. Tax benefits are essentially not refunds that were owed from the government. Tax benefits represent certain items that reduce our tax liability. So in this case, what you see is back here. What you see is the company as a whole had 184,000 in taxes from continuing operations, and then it had tax effects from its discontinued operations. Overall, the tax liability for the company, continuing and discontinued operations, is 167.8. Okay, that's what the IRS is expecting. Okay, they don't really care that we have continuing operations and discontinued operations. They look at the company as a whole and say, "Pay me my money. You owe me 167,800." Okay. In our tax return, we break down, of course, that there's a tax benefit and there's a tax liability as such. You can go a little bit further if you wanted to and figure out what the net income is on a gross pre-tax basis for the discontinued operations. Here we say, if you look at the income statement of just the pizza division that we're getting rid of, it would show pre-tax income of 78.8. And that's just working backwards, just using algebra and working our way upwards here. If you looked at the loss, what was essentially the pre-tax loss or the gross loss from selling certain assets of the pizza division, you can work backwards and say, well, when we sold everything off, there was a $131,000 gross loss on everything. We got a tax benefit of 41. That helps reduce our overall tax liability, but overall the net loss after tax is 90,000. Now we're getting rid of it, regardless of the reason why, and we want to be able to show not all of this. We just want to summarize as much as possible. Give me the net of tax, give me the net of tax, give me the net of tax, and then just tell me the net of tax at the bottom line here. Okay, that provides investors some useful information. Here's what we're getting rid of, here's what we're continuing, here are the tax implications. That's what's called interperiod tax allocation. Just showing everybody where the tax effects are between continuing and discontinued operations. Now, you might recall this phrase, comprehensive income, from Chapter 2. Remember all the different elements when we're talking about, hey, the company has assets, has liabilities, has these equity components, it has revenues, it has expenses. Remember those 10 items. One of the things they mentioned in Chapter 2 was this notion of comprehensive income. Well, that's what we're talking about here. Comprehensive income, most of the time, is just what you and I know as net income. That is, income after tax. Okay, why do they call it comprehensive income? Why don't they just call it net income? Well, the problem that the FASB and the SEC faced back in, well, the 80s, 1980s really, was that there was certain activity that really should not affect net income. I mean, it does, but it doesn't. And that becomes more difficult when you're a professor trying to explain it to students. Well, how do you have like gains and losses that affect income but not really? Well, the types of things we're going to be looking at here generally result from investments. Investments and any type of distributions. We'll look at one particular case, and that's all I'm going to have you worry about when it comes to this topic. So realize the item, the activity we're going to look at is called other comprehensive income. So just to give you a heads up, we want to show on our multiple step income statement, and just ignore discontinued operations for right now, we want to show pre-tax income. Okay, we want to show the tax, and then we want to show after tax or post-tax income. Okay. Now, generally speaking, this is what we call net income. Okay. If there is any type of holding gain or loss from our investments, and that's what we're going to look at here, holding gains and losses or paper gains from our investments, we want to show them not above, we want to show them below net income. So you're going to see this thing called OCI, and it's going to relate specifically to any type of unrealized holding gains or losses from a certain type of investment. The OCI could be an unrealized holding gain, or it could be an unrealized holding loss from our investment. Let's just assume that it's an operating other comprehensive loss, and we have to subtract this holding loss from our what we normally call net income to get us what's called comprehensive income. So what does comprehensive income mean in this whole situation? Comprehensive income really represents our net income plus or minus any of these weird types of gains or losses. Companies may have comprehensive income, maybe they don't. But the FASB and the SEC decided several years ago, look, there's some things that we don't want, some activities, some gains and losses that we don't want to have affect our net income post-tax. All right, so what types of gains or losses are we talking about here? What's sort of like the voodoo gains and losses? Well, let me give you an example here. Companies can invest in other companies. So imagine that a company has a cash account. Okay. And what it decides to do is says, oh, we got lots of cash here. Let's put it in the market. Maybe we get some interest. Maybe we get some dividends. Let's take, say, $100,000. Okay. And let's purchase what we call available for sale debt securities. Now, for all intents and purposes, these debt securities, these investments, they're just bonds. We decided to buy $100,000 worth of bonds. Okay, we call them debt securities because bonds are essentially other people's debt. We're like a bank. When we buy another company's bonds, we give them cash. They give us essentially a promise to pay back that cash plus interest. So these are just bonds. Like you and I can buy bonds. Okay. So now I got this $100,000 worth of bonds. Okay. Why do you buy bonds? Well, you buy bonds because they are pretty safe investments. You're going to get your money back and get the $100,000 back, but you're also going to get some net income too. So when you look at the income statement, you're going to see, if anything, some type of interest revenue or interest income account from debt securities. Okay? What this means is, hey, our bonds, they pay us interest on a maybe quarterly, semi-annual, or annual basis. And let's assume that in this case that we got some interest income. Okay, maybe this year we got of the 100,000, maybe we got $5,000 worth of interest. Kind of cool. It's something. It's better than nothing, and that's the whole reason why we, as a company, invest our money. We want to get something. It's not doing anything in our checking account, so I'll put the 5 there. If we get some sort of cash interest income, we're going to debit the cash account, just immediately deposit into our operations and credit the interest revenue account. But realize this interest revenue account, it's not going to be somewhere at the top of the income statement. It's going to be somewhere towards the middle or the bottom. It's going to be that other revenue type stuff in the income statement, somewhere towards the middle. It's incidental, it's yay, it's fun, but it has nothing to do with our core operations. Another key feature about AFS securities is most companies will elect fair value accounting for their investments. Now, ordinarily, we just leave our investment securities at historical cost, just like we would any other type of asset account. But the FASB says, in this particular situation, it's okay to mark to market the value of these securities. So maybe when we bought the securities, we paid $100,000, but maybe they've gone up in value. So in our financial statements, or excuse me, in our accounting system, we see that, yes, at the end of the year, the $100,000 is what we paid for, but when we look at the market, the closing price of these bonds, we see that it's actually now $130,000. So our mark-to-market accounting says, look, because it's gone up, it's increased by $30,000, you can go ahead and put in a debit to this asset account to increase it to its closing value. That's mark-to-market accounting. The problem with doing this, however, is this $30,000 increase, that's just a paper gain, okay? Otherwise known as an unrealized or holding gain. Okay? It's nothing to get excited about. And remember, when you're an investor, you know that gains are great, but you have to cash them out at some point in order to realize them. So when we see this paper gain right here, we're allowed to increase our assets by $30,000. Great. Overall, our assets increase by $30,000. Where do we put the offsetting credit? Well, we have an unrealized holding gain on debt securities account. This is also an income statement account. And what we'll do is we'll show over here, there's our $30,000 debit, we'll show a $30,000 unrealized holding gain, credit. Now the question comes down to this. Should we show this holding gain of $30,000 in the same place we show interest revenue on the income statement? Because the income statement is going to be scrutinized. You have revenues, you have expenses, you get other income, other revenues. There's the 5, right? And you've got ultimately net income. Should I show this paper gain of $30,000 with this interest revenue of $5,000? The $5,000, remember, I got that in cash. So it makes sense to say, hey, put that in the income statement and make sure it affects net income. Because, hey, look, I actually got that in cash. I'm cashed out. But this $30,000 unrealized paper gain, I don't think I want to show it with these other gains or these other revenue items because, hey, I haven't cashed it out yet. And that's what the FASB said. They said, look, if you've got this unrealized holding gain on debt securities, AFS debt securities, put that as, call that other comprehensive income, put that down here, and call that as part of overall comprehensive income. Do not show it with net income because this net income is what we use to calculate earnings per share. And investors will get confused if we show paper gains with our net income, especially for the simple fact that we haven't cashed out on these. More to the point, these are holding gains. We don't really know whether or not we'll be able to cash that out in the future. It could just be a temporary market anomaly. Maybe within the next month, it turns into a loss. We don't know, but it's a holding gain. Let's not confuse that with net income. So, example, Trader Bob. Trader Bob has total comprehensive income of 140. What does that mean? Well, it means it has after-tax net income, it has other comprehensive income, and it has the CI of 140. Okay? That's everything all in. But it doesn't want to confuse investors about what 140 means. So it says, look, core operations for the period after tax was 110. Okay? There's this paper gain of 30. Let's keep that separate. Okay? Let's not mix that together with net income because we haven't actually cashed out on that. So why do we have this bottom line now called comprehensive income instead of net income? Is because there are certain things when we see assets go up by 30,000, right? We know that on the other side we must show an increase of 30,000 to equity. But how do we do that if it's not really cash? It's a valuation adjustment. And that's why the FASB says if you have to increase any type of equity account, don't let it be retained earnings. Don't let it be part of your revenues, expenses, gains, or losses for the year. Move that into something else. So we're actually going to put this 30,000 somewhere separate than the net income. So under the equity account, okay, what we'll see is retained earnings increase by 110 for the net income, and we'll park these other comprehensive income, this unrealized holding gain, into an account called accumulated other comprehensive income 30. And what that means is, look, this is what's available for dividends. This is who the hell knows. This is just I call it a rest stop on a highway. Okay? We don't want this activity included in the traffic, the core traffic from our operations. This might eventually turn into cash. If we do sell the security, we'll eventually remove it and put it up into retained earnings. But for right now, it's just this unknown sort of phenomenon that we have to record because on the asset side, we have a corresponding increase. Okay? All of this retained earnings right here, we know that there's a net increase to our assets, net of our liabilities of 110. But that's not the issue here. We know that this net income of 110 happens for a variety of reasons. Sometimes it's an expense that results in a liability. Sometimes it's cash from sales, whatever. But the key thing here is what do we do with this particular increase in assets if it's not cashed out yet? So what do we do when we have these paper gains that we don't want to show as part of dividends? Well, the simplest way of reporting this unrealized holding gain from debt securities, and that's the key thing here. We see unrealized holding gains. This is from available for sale. You'll see this in the homework. Available for sale debt securities. This is the only type I included on the exams too. You have an investment in bonds called available for sale, which you'll learn more about in the Intermediate 2. Keep that separate. But go ahead and show your core operations here. Okay? Actually, let me put it over here. This is our core operations. This is OCI, other comprehensive income of $30,000. These items, these are all closed out to retained earnings. You will see a net 110 affected right there. So after we close out our revenues expenses, just as we saw in chapter 2, there's the 110. It's probably included with other previous balances in there, but that's where we see that. AOCI, we take that, we close that unrealized holding gain account to AOCI, just as we would any other type of a gain account up above. This is a gain account. It has a credit balance. We just park it over here. Boom. And we leave it there until we decide we want to sell it. Then we'll eliminate this. We'll reverse it out. Two separate accounts. One is available for dividends. This one is we don't know what's going on, but we need to report some sort of offsetting change. That's one way of reporting it, but most companies prefer the two-statement approach. They like to have a specific income statement separated from a comprehensive income statement because this is what investors are used to seeing. This is net income. This is what's used to calculate earnings per share. We know that this ultimately goes inside retained earnings. What's this other statement that you see on the next page? Well, we call it comprehensive income. It starts first by showing what was net income from the income statement, showing this OCI here of 30,000 and saying this is the true bottom line to the business. But we want to make sure it's very distinct, that the 140 really isn't all available for dividends. Really just the 110 is available for dividends. So what do we see? What is the gains and losses that bypass net income temporarily? We call that OCI. Okay, key thing to remember, okay, and this is important too. CI is our new bottom line, meaning that yes, in the past we had net income as the bottom line, that was after tax. Whatever that is, if there is an OCI item, that is in between. That goes there, and we get comprehensive income at the very, very bottom. Okay. Could be other comprehensive income. If it's a loss, called other comprehensive loss. But the key thing here is it's separate. And we'll pick this up on Monday.